The 1.5 billion bet that backfired spectacularly. Do not make so many small points. 1500 words do not repeat the companies that are discussed in previous. Imagine this. A startup once crowned a unicorn. A private company valued at 1.5 billion suddenly collapses into bankruptcy after burning through cash, losing investor confidence, and attracting legal scrutiny. What looked like a rocket ship success story turned into a chilling warning about hype-driven valuations, poor financial discipline, and the brutal realities of building a sustainable business in today's hyper-competitive tech landscape. Today, we're unpacking the 1.5 billion bet that backfired spectacularly, a dramatic rise and fall story that touches on ambition, investor psychology, and the danger of mistaking valuation for value. This isn't fiction, it's about Builder.ai, a company that at one point seemed poised to redefine how software is built, and then collapsed so completely that its downfall is now being closely examined by authorities. Strap in. This is not your typical bailout or write-off story. This is a deep look at how a massive valuation turned into a cautionary tale. Long before its collapse, Builder.ai was celebrated as a breakthrough in artificial intelligence and software development tooling. The company marketed itself as a way for businesses to build software applications without needing engineers, a simplification of complex development that sounded compelling to both investors and customers. Its pitch resonated so strongly that it raised hundreds of millions in funding from heavyweight backers, including Microsoft, linked investors, and even sovereign wealth capital from Qatar. For a while, Builder.ai looked unstoppable, a company prepared to challenge the status quo and unlock a new era of AI-assisted creation. Yet behind that striking 1.5 billion valuation, the symbolic threshold that once meant this company is a future giant, there were deep problems. Problems that would not stay hidden for long. The dream that didn't deliver. Here's how it was supposed to work. Builder.ai would use artificial intelligence to automate large chunks of software development, democratizing creation and slashing costs. The entrepreneurs without technical expertise could launch products. Established companies could accelerate internal projects without expanding engineering teams. In a world where software defines business competitiveness, that value proposition seemed real, but the reality turned out to be very different. Instead of delivering consistent, scalable, and reliable software workflows powered by AI, Builder.ai became synonymous with operational instability. Customers complained about unfinished products, implementations that veered wildly off schedule, and costs that ballooned well beyond initial promises. The promise of automation was often replaced by manual workarounds and expensive consulting teams. That friction undermined the very reason investors once got excited in the first place. Meanwhile, internal issues festered. Rather than conservative financial management, Builder.ai reportedly engaged in odd accounting patterns, like shipping revenue through unconventional customer deals that made the company's financial picture appear healthier than it truly was. Deals that looked like billions in revenue on paper were actually far more fragile beneath the surface. Other red flags emerged. The company went an unusually long time, reportedly 18 months, without a chief financial officer, a role essential for overseeing financial health, reporting accuracy, and sustainable growth planning. That absence wasn't just unusual, it was a symptom of deeper dysfunction. When reality catches up, the turning point came when cash started tightening. Construction projects slowed, investors stopped writing checks, and then, just when the narrative needed stability, the company filed for bankruptcy, a dramatic collapse from the vaunted 1.5 billion valuation just months earlier. Bankruptcy isn't just an administrative status. It's a public admission that the business cannot service its debts and obligations, and that its business model could not deliver on investor expectations. For Builder.ai, a company once celebrated as a next-generation tech leader, bankruptcy sent shockwaves through the startup community. Suddenly, the question wasn't whether Builder.ai might disrupt the market. It was how such a high-profile company spiraled into insolvency so quickly. Why this matters to entrepreneurs and investors. There's a hard lesson here, one that transcends just one company's failure. In the world of startups and venture capital, valuations are often treated like a proxy for real value. A 1.5 billion valuation gets headlines. It attracts attention, it can bring talent and partnerships, but valuation alone doesn't guarantee customer success, product market fit, or sustainable revenue. In Builder.ai's case, that disconnect became painfully clear. The company's valuation reflected investor belief about potential future value, not actual financial performance or a proven business model. This is a pattern we've seen time and again in techs. A seductive vision attracts billions in funding. Investors stamp their excitement with multi-hundred million or billion-dollar valuations. The company struggles to convert potential into profits. Eventually, reality, in the form of slowed growth, missed targets, or financial losses, forces a reckoning. But what made Builder.ai's failure particularly dramatic was the scale of the ambition versus the simplicity of its core challenge. Building reliable software solutions with AI is inherently hard. Software engineering is complex not just technically, but socially. It involves understanding client goals, iterative design, quality assurance, and ongoing maintenance. AI can assist, but it cannot replace the nuanced judgment of expert engineers across all contexts. In Builder.ai's model, that nuance was underestimated, and the market punished it harshly. Behind the scenes, the human cost, what often goes unreported in stories like this, is the human impact. When a startup collapses, employees lose jobs, often abruptly. Customers may be left with unfinished products. Partners and vendors are left holding unpaid invoices. Investors absorb losses that can ripple through their portfolios. For every headline that talks about a company crashing, there are real people whose plans and livelihoods were tied up in that business. In the case of Builder.ai, early employees who joined a high-growth company expecting stability suddenly found themselves caught in bankruptcy proceedings. Investors who thought they were backing the next big AI frontier were left holding a significantly impaired asset. It's a stark reminder that behind every valuation, there are human decisions, hopes, and risks. So what lessons do we walk away with? This isn't just a story about one startup that failed. It's a broader lesson on how hype, perception, and narrative can outpace reality in the tech world. Here are the takeaways that any entrepreneur, investor, or curious observer should internalize. 1. Valuation of value. A high valuation doesn't mean a company has product market fit, sustainable revenue, or long-term viability. 2. Reality trumps narrative every time. Buzzwords like AI, automation, or unicorn potential can draw attention, but they don't guarantee success unless the business fundamentals are strong. 3. Financial discipline matters. Running a business is as much about managing cash flow, product delivery, and customer satisfaction as it is about growth. 4. Transparency and leadership are critical. Lack of solid financial oversight, such as going a long period without a CFO, can be a red flag, not a trivial detail. 5. Execution is everything. No matter how great a concept sounds, if execution falters, whether in product delivery, sales, or financial controls, the company will eventually face consequences. The bigger picture. Today, the collapse of Builder.ai serves as an important signal in tech. The market is maturing. Investors are becoming more discerning. It's no longer enough to tout AI integration or future potential. Companies must demonstrate concrete paths to profitability and sustainable operations. And while some companies will undoubtedly still rise to meet that challenge, others will fall, especially those that rely too heavily on hype without clear execution strategies. The Builder.ai story teaches us that the biggest tech gambles aren't just about innovation, they're about judgment. It's one thing to imagine the future. It's another to build a business that thrives in it. And here's something that might make you pause. For every Builder.ai that collapses, there are dozens of companies quietly grinding away, building real products, serving real customers, and creating incremental value. And those are often the ones that win in the long run. Because in business, overnight success is usually years in the making. Now tell me this, what tech company do you think is overvalued right now? And which one has the resilience to break through and succeed? Drop your thoughts in the comments. I want to hear your takes. That's the real discussion we need to be having.